This graph compares two paths to entrepreneurship. The red line is the startup J-curve. You bleed cash for years, deep into negative territory, hoping to break even. The green line is what happens when you buy an existing business, stepping into day one cash flow. Right now, a massive generation of baby boomer entrepreneurs is heading into retirement. These are the people who built long-standing, community-based businesses decades ago. Half of all small business owners in the United States are over the age of 55, and the vast majority of them do not have a next-generation successor in the family ready to take over the operation. We are looking at highly profitable, foundational local businesses, like landscaping companies and service firms, and local butcher shops that will simply close their doors if they can't find a buyer. This demographic shift creates a massive supply of established, cash-flowing businesses sitting on the market, ready for a new generation of operators to take over. Let's say you're a highly capable manager, and you spot a successful company in your industry valued at $1.2 million. You know exactly how to run it. The standard route to finance this is the Small Business Administration's 7A loan program, designed to fund up to 90% of the purchase price. This chart breaks down the transaction. The bank covers the bottom 90%, but underwriters strictly mandate a 10% equity injection. Earning a standard $60,000 salary, pulling together that $120,000 cash gap is virtually impossible. With millions of businesses hitting the market, how can an everyday person afford to acquire one without destroying their personal finances? In the world of acquisitions, you don't necessarily need a massive bank account to close a deal. You need intelligent deal structure. There is a specific method of creative financial engineering designed to bypass the bank's cash down payment requirement entirely. Financing this 10% injection often comes from a seller note, a private loan provided directly by the retiring owner of the business to the new buyer. This graph shows how this alters the math. We still have that empty 10% equity gap. Instead of bringing your own savings, the seller note is inserted to cover that exact 10% injection. It legally acts as a substitute for your cash. Why would a bank underwriter ever agree to accept a loan from the seller as your required skin in the game? The bank will only approve the structure if a highly specific, restrictive legal condition is applied to that seller's loan. That condition is known as full standby. It is the exact legal mechanism that allows the zero-down deal to proceed. This timeline maps out how full standby operates post-closing, from month 1 through month 24. Under this agreement, you are legally bound to pay $0 in principal and $0 in interest to the seller for the first 2 years of ownership. Because the business's cash flow isn't burdened by paying the seller back during those early years, the bank treats the seller's loan as true, stable equity. The retiring seller agrees to delay 10% of their money because the SBA loan guarantees they walk away with 90% of the $1.2 million purchase price in cash at closing. By deferring their final payout, the seller provides the bridge that legally functions as a substitute for the buyer's cash down payment. Let's look at the financial reality for that manager immediately after the ink dries. This chart contrasts the buyer's previous life as an employee against the cash flow they now control. They swap a $60,000 W-2 salary for $250,000 in seller discretionary earnings. It is a direct exchange of risk. You take on the ultimate operational responsibility of running the company, but you immediately harvest the profits from day one. The incentives align. The bank secures a reliable, government-backed loan, and the retiring seller instantly secures the majority of their retirement fund. An everyday manager legally acquired a $1 million asset and quadrupled their earning power, leveraging a structural loophole rather than an upfront cash injection. But a deal requiring zero money down does not mean the transaction is without severe risk. Acquiring a broken business at 10 times its actual worth is a financial disaster, even if your upfront cost was zero. You have to rigorously verify the seller's financial claims, audit the tax returns, and scrutinize whether the revenue relies entirely on just 1 or 2 major customers. This graph illustrates the transition dip. You must prepare for a typical 2 to 5% drop in revenue that almost always occurs immediately following a change of ownership, before things stabilize. The zero-down loophole proves that in the modern era of business acquisition, a lack of capital is no longer an excuse. Structural knowledge and operational competence are the ultimate currency. Last time, we broke down how an entrepreneur can legally acquire a multi-million-dollar business without using a dime of their own personal capital. The Small Business Administration demands a 10% equity injection from the buyer to approve the loan, but that down payment doesn't actually have to come from your checking account. Look at this graph illustrating how that initial 10% equity can be structured. Instead of putting down cash, that entire block can be covered by a seller note, a loan provided directly by the seller of the business to the buyer. To make this work with the bank, that seller note has to be placed on what is called full standby. This timeline shows the mechanics. If the seller officially agrees to receive exactly 0 payments of principal or interest for the initial 24 months, the primary lender is allowed to legally count that debt as the buyer's required equity. You satisfy strict federal banking regulations. The seller gets the asking price, and you take ownership of a cash-flowing asset with 0 personal capital at risk on day 1. Combining an SBA 7A loan with the search fund model creates immense financial leverage. It allows everyday operators to punch far above their weight class and acquire serious, established companies. This data visualization tracks the performance of over 800 search funds studied by Stanford University. The results show a 33.9% internal rate of return and a 2.88 public market equivalent. That means these heavily leveraged acquisitions consistently crush standard stock market returns. But leverage swings both ways. Adding massive debt to a small business leaves 0 room for operational errors, market downturns, or simple bad luck. This chart shows the uncompromising reality of the acquisition space. 33% of these search funds fail to ever buy a business, and of the deals that do close, 25% result in a loss of invested capital. Behind those corporate failure rates are severe personal dangers. To get the SBA loan, buyers must sign a full personal guarantee, putting their home and personal assets on the line. And if they funded any gap using a ROB structure, rolling over retirement funds into the business, a failed acquisition can trigger massive IRS penalties on top of losing their entire nest egg. The zero-down acquisition is a financial high-wire act. The potential for astronomical, rapid wealth generation is perfectly counterbalanced by the very real threat of personal financial ruin. Let's assume you successfully navigate the risks and take control of a highly profitable company. Your immediate problem is that heavy corporate taxation will eat the very cash flow you need to pay off your massive acquisition debt. So, how do you protect that revenue? This graph illustrates the scale of a specific part of the tax code known as Section 179. It allows businesses to immediately deduct the full purchase price of qualifying equipment or software from their gross income, up to a maximum limit of $2.5 million for the 2025 tax year. The common assumption is that to claim a $2 million tax deduction, you have to drain $2 million of cash from your own business bank account to buy the equipment. You don't. Section 179 effectively transforms standard, necessary operational purchases into immediate tax shields, setting the stage for aggressive financial engineering. The loophole's real power is unlocked when Section 179 interacts with leveraged debt rather than cash. This side-by-side comparison illustrates the accounting trick. You can finance heavy equipment entirely with a business loan, paying exactly $0 in cash out of pocket today. Yet, you deduct the massive full purchase price of that asset immediately from your taxable income this year. Then, you stack benefits. Over the next several years of paying back that equipment loan, you also claim ongoing interest deductions on that exact same financed purchase. By stacking an immediate full price deduction on top of ongoing interest write-offs, all while using a bank's money to make the purchase, operators drastically reduce their tax burden and create a massive protective shield around their revenue. You bought the business with other people's money. You shielded the operational cash flow from taxes to pay down the debt. Years later, you decide to sell the company for a massive profit. Sophisticated buyers have a strategy to protect this final payout too. Section 1202 protects massive gains. Hold the stock for 5 years and you slice off the first $15 million, excluding it entirely from federal tax. For acquisitions under that limit, like a $12 million sale, the federal tax owed drops to exactly 0. This comparison highlights the absolute equivalent in the real estate world, the 1031 exchange. Just as property investors legally defer taxes by rolling profits into new buildings, Business buyers use Section 1202 to protect their equity. Section 1202 functions as a specialized mechanism to legally erase federal taxes on the largest liquidity event of an entrepreneur's life. But what happens if an incredible, life-changing buyout offer arrives in year 4 and you cannot wait for that strict 5-year holding period to finish? This introduces the ultimate contingency plan, Section 1045. It acts as a rollover mechanism, allowing an owner to take the capital from a premature sale and funnel it directly into a new qualified small business investment, keeping the tax shield perfectly intact. When you zoom out, the entire architecture reveals itself. Highly leveraged senior debt and standby seller notes secure the asset. Interlocking tax shields protect the revenue. And sitting at the center of it all is the daily cash flow of the acquired business. It acts as an automated engine, systematically paying down the massive debt load while building immense, tax-protected personal equity for the new owner. If this level of wealth generation can be achieved by manipulating the laws of a single nation to buy a single business, what happens when this exact same architecture is deployed across multiple countries at once? We will explore that next.